It was a down week. Gold prices dropped about 4%, which is a pretty big drop. But considering how much gold had gone up, not unusual. I mean, nothing moves in a straight line. And gold volatility has picked up recently, both on the upside and now on the downside. So gold settled the week just above 3,200, 3,202 approximately. I think there's a lot of support around this level. I think anything below 3,200, I think you're buying near the bottom. But for now, let's talk about what happened during the week in gold and silver. It was a down week. Gold prices dropped about 4%, which is a pretty big drop. But considering how much gold had gone up, not unusual. I mean, nothing moves in a straight line. And gold volatility has picked up recently, both on the upside and now on the downside. So gold settled the week just above 3,200, 3,202 approximately. I think there's a lot of support around this level. I think anything below 3,200, I think you're buying near the bottom. In fact, I think 3,000 is the new 2,000. If you recall, when gold was around 2,000, when it initially broke out earlier last year, I was encouraging clients of Schiff Gold to buy that breakout. I said 2,000 was the new floor for gold, and it turned out that that was the case. And people who bought, in the low 2,000s, 2,100, 2,200, are in a very good position now with gold $1,000 an ounce higher. Yes, gold did almost hit 3,500. That was a few weeks ago. That is not going to be the high for this bull market. I think years from now, you won't even notice this little bit of a correction. And 3,500 will be much lower in the rearview mirror than where we're going. So that's just a stop in a much bigger bull market. Silver prices also declined on the week, not quite as much as gold. Of course, silver didn't go up nearly as much as gold. So silver was down about 1.7%, closed around $32.26, something like that. Gold is up about, I think, 40% since the summer of 2024, June, July timeframe. Silver is up less than 10% during the same period of time. In fact, I think when gold broke 2,000, silver was, maybe $28 or something like that. And I remember when silver broke above 30, I said that, well, $30 silver was like $2,000 gold, meaning that you were buying the bottom, because I didn't really expect silver prices to go back below 30. And if they did, I didn't think they'd stay there for any significant amount of time. Well, I still think that's the case. The difference is you could still buy silver very close to the floor at 32. In fact, buying silver today, it's almost like turning back the clock to when gold was at 2,000, because we're not much higher now in the price of silver. In fact, the gold-silver ratio is about 100 to 1. You can get 100 ounces of silver for every 1 ounce of gold. That is a ridiculously low price for silver. I think we almost got to 110 when gold had, spiked up to close to 3,500. That may be the record low for silver. We'll see. I mean, this has been a big bear market in silver when you price it in gold, which is real money. But I think that if this bear market has finally bottomed, we have tremendous upside in the price of silver. And so if you missed out on $2,000 gold, well, you're in luck, because you could still buy $32 silver, which I think is a similar entry point. And the main reason that gold has been so much stronger than silver is because the main drivers have been central banks. Central banks have been buying lots of gold. They just don't buy silver. They don't have the place to store it. It's not their reserve asset. Gold is the money for central bankers, not silver. Silver is more the people's money. And the people haven't been buying, but the central banks have. And if you're smart, you'll follow the bankers, because they're really the insiders. It's like when the management is buying stock of a company, it's generally a good sign because they're the closest to the company and they're buying. So they must know something. They have some confidence. Well, the central bankers are the insiders of the global fiat monetary system, and they're buying gold. And that means they're selling dollars. And so in that sense, it's like the insiders dumping their stock. And if insiders are selling their stock, well, maybe you should sell yours too, because they might know something that you don't. And I think what the central bankers know that a lot of people don't know is that the dollar's days as the world's reserve currency are numbered. And that number may not be very large. And so they've been moving out of dollars, and that accelerated on Liberation Day. And that's why we got that big spike in the price of gold. And that's why we've had a pullback, because over the last couple of weeks, Donald Trump has basically walked all that back and surrendered in the trade war. First, he surrendered against the world and rolled back all the reciprocal tariffs with a 90-day pause, which, is probably going to be permanent, I guess. But he left the reciprocal tariffs on China, and he finally surrendered on that front as well by rolling those back with another so-called 90-day pause. Although I think today or the other day, Donald Trump mentioned now that he's actually not going to be entering into all these negotiations for new trade deals. He's just going to be sending out memos to let each country know what the tariff is going to be with respect to that country. And I believe that the rates are going to be far lower than the reciprocal rates that correctly, scared people into selling stocks and buying gold. Because I think the institutional investors, when they saw what Trump, unveiled, and the markets reacted, the stock market, the bond market, the dollar, we finally saw some institutional movement into gold, which accelerated a trend that was already in motion, because now you had some private demand competing with the government demand, the central banks, and even some retail buying. Not a lot. I think it was more some of the institutional buyers that went into gold, not so much the individual. I mean, we saw a bit of a pickup at Schiff Gold, but nothing really substantial, not like we did, back in the COVID days when we saw a real retail rush into gold. We didn't see that post-Liberation Day, but we did see some institutional money moving in. And of course, the central banks probably stepped it up a bit, and we got that spike. But now that everything is de-escalated, we've had a pullback in the price of gold, along with a big rise in the stock market. In fact, the stock market in the U.S., which pretty much went into a bear market following Liberation Day, now that we've canceled Liberation Day, the stock market has recovered everything that it lost. And so as you've had investors now re-embracing risk assets, they sold the safe havens. And so people who rushed into gold because they were worried are now selling their gold because they're not worried anymore, and they're buying stocks. But all of the fundamentals that were driving the price of gold higher before Liberation Day are going to continue to drive it higher, even though we're no longer liberated, even though we've canceled all those reciprocal tariffs. And I think the markets are going to start to turn their attention to other issues that are going to be very bullish for gold, meaning the deficit. Because one of the, campaign promises of Trump was to cut government spending, to pay down the debt. And a lot of people believe that, especially when we had the introduction of Doge with Elon Musk, and they were coming out with all these announcements of big cuts in waste, fraud, and abuse. Well, I think most of the Doge cuts have been made, and the reality is it doesn't amount to anything significant when you compare it to the overwhelming size of the federal budget and the spending increases that are in the pipeline that are going to dwarf whatever Doge managed to cut. But not only is the Republican Congress debating how much more money the government is going to spend, they're also cutting taxes. And they're not raising taxes on anybody, not even the millionaires or the billionaires. They're cutting taxes across the board, and they're increasing government spending. So the budget deficits that Trump inherited from Biden are going to be bigger, not smaller. We're going to have larger deficits, and we're going to have even more pressure on the Fed to monetize those deficits, not just with rate cuts that are eventually going to come, but with a return to quantitative easing.